The large default? The dozen nations within the threat quarter. London traditional debt disaster signs and symptoms of crashing currencies. 1,000 foundation point bond spreads and burned FX reserves point to a document range of developing nations now in problem. Lebanon, Sri Lanka, Russia, Suriname and Zambia are already in default. Belarus is on the brink and at least another dozen are in the threat zone as rising borrowing fees, inflation and debt all stoke fears of financial disintegrate. Totting up the value is eye-watering. Using 1,000 basis factor bond spreads as a pain threshold, analysts calculate $400 billion of debt is in play. Argentina has by means of some distance the maximum at over $150 billion, at the same time as the next in line are Ecuador and Egypt with $40 billion, $45 billion. Crisis veterans wish many can nevertheless avoid default, especially if global markets calm and the IMF rows in with help, however those are the nations at risk. Argentina, the sovereign default world document holder, looks probable to add to its tally. The peso now trades at a close to 50% cut price within the black marketplace, reserves are seriously low and bonds change at just 20 cents within the dollar, less than half of what they were after the United States' 2020 debt restructuring. The authorities would not have any substantial debt to provider till 2024, but it ramps up after that and issues have crept in that powerful VP Cristina Fernandez de Kirchner might also push to renege at the International Monetary Fund. Graphic. The pain has spread. Ukraine-Russia's invasion means Ukraine will nearly surely must restructure its $20 billion plus of debt. Heavyweight investors inclusive of Morgan Stanley, NYSE, MS, and Amundi warn. The crunch comes in September when $1.2 billion of bond payments are due. Aid cash and reserves mean Kyiv should doubtlessly pay. But with state-run Naftogaz this week asking for a 2-year debt freeze, investors suspect the authorities will observe in shape. Graphic. Ukraine bonds brace for default. 20 image percent. 201,657,725,996,621. PNG. Tunisia. Africa has a cluster of nations going to the IMF, however Tunisia seems one of the maximum at chance. A close to 10% price range deficit, one of the maximum public area salary payments in the world, and there are concerns that securing, or at least sticking to, an IMF program can be hard because of President Kai's side's push to reinforce his grip on power and the USA's powerful, incalcitrant labor union. Tunisian bond spreads. The top-rate traders' demand to shop for the debt in place of U.S. bonds have risen to over 2,800 foundation points, and alongside Ukraine and El Salvador, Tunisia is on Morgan Stanley's Pinnacle 3 list of likely defaulters. Address the International Monetary Fund becomes imperative. Tunisia's significant financial institution leader Marwan Abbasi has mentioned. Graphic. African bonds suffering 20 image percent. 201,657,541,934,055. PNG. Ghana. Furious borrowing has visible. Ghana's debt to GDP ratio jumped to almost 85%. Its foreign money, the cedi, has lost almost 1/4 of its cost this year, and it become already spending over 1/2 of tax sales on debt interest payments. Inflation is also getting near 30%. Graphic. How not to spend it. Egypt has a near 95% debt to GDP ratio and has seen one of the biggest exoduses of international coins this year, some $11 billion, in line with JP Morgan, NYSE, JPM. Fund organization FIM Partners estimates Egypt has $100 billion of difficult foreign money debt to pay over the following 5 years, which include a meaty $3.3 billion bond in 2024. Cairo devalued the pound 15% and asked the IMF for assist in March. However, bond spreads are actually over 1,200 foundation points and credits default swaps (CDs), an investor tool to hedge risk rate in a 55% risk it fails on a fee. Francis Balcells, CIO of MDebt at FIM Partners, estimates even though that more or less half the $100 billion Egypt desires to pay by way of 2027 is to the IMF or bilateral, particularly inside the Gulf. Under regular conditions, Egypt should be able to pay, Balcells said. Graphic. Egypt's falling foreign exchange reserves 20 image p. C 201,657,817,324,629. Kenya spends kind of 30% of revenues on interest bills. Its bonds have misplaced nearly one-half their price and it presently has no get right of entry to capital markets, a hassle with a $2 billion bond coming due in 2024. On Kenya, Egypt, Tunisia and Ghana, Moody's NYSE, MCO, David Rogovich said, these international locations are the maximum prone just due to the quantity of debt coming due relative to reserves, and the financial demanding situations in phases of stabilizing debt burdens. Graphic. Kenya's issues 20 image percent 201,657,872,126,738. PNG. Ethiopia. Addis Ababa plans to be one of the first nations to get debt comfort beneath the G20 Common Framework Program. Progress has been held up by the U.